Should you itemize or should you take the standard deduction? Will the standard deduction or itemized deduction save you more in taxes? Well, it all depends on how much you have in itemized deductions. But whether you use the standard deduction or if you itemize your deductions, either deduction will reduce your taxable income. I'm sure that you already know that you can take the standard deduction or you can itemize your deductions, but you can't do both. Normally, it's your choice on which one you want to take. What you may not know is sometimes the IRS won't allow you to use the standard deduction, so you're forced to use itemized deductions instead. You can't take the standard deduction if you're married filing separately and your spouse itemizes deductions, or if you change your accounting period and file a tax return that is less than 12 months, or if the return is for an estate, trust fund, or partnership, or in some cases, if you are a non-resident alien or a dual status alien. If you're able to take the standard deduction and you choose to take the standard deduction, you will get the same deduction amount as everyone else who has the same tax filing status as you. Everyone is equal, and it doesn't matter how much you make in income. But if you're 65 or older, or if you're blind, you can get a higher standard deduction. So the standard deduction for 2024 is $14,600 for singles and for married filing separately, $29,200 for married filing jointly, and $21,900 for head of household. If someone else claims you as a dependent on their tax return, the standard deduction on your own tax return might be lower. If you are a dependent, you can take the greater of $1,300 or your earned income plus $400. But your standard deduction can never exceed the maximum standard deduction amount allowed. Let's look at how a single person earning $25,000 per year would be affected by the standard deduction. After this taxpayer reduces their income for the standard deduction, they would have $10,400 of income that can be taxed. It's quite possible that this taxpayer will be able to take other credits, so more than likely their taxable income would be even lower than that $10,400. Now, the thing is, you want to try to come up with itemized deductions that total more than the standard deduction. This way, you can reduce your taxable income more by using itemized deductions instead of taking the standard deduction. The problem is, it's usually difficult to come up with enough itemized deductions to exceed the standard deduction. Let's go through some itemized deductions that can be included on Schedule A of your 1040 federal tax return. I want to start with a couple of deductions that aren't used very often, but you might possibly need someday. First, if you ever win money gambling, the IRS will tax those winnings. Well, you can deduct gambling losses to offset some or all of your winnings, so be sure to keep proof of your losses. You can't deduct more than the amount of winnings that you include on your 1040 tax return, but at least you can offset the income. Second, if you're ever ripped off in a Ponzi scheme, you can deduct it as a theft loss. There are so many scams and schemes out there nowadays that you might slip up and fall for one of them. At least you might be able to take a deduction if someone swindles you out of your investments or money. Okay, now let's go through some of the more common itemized deductions that you can take. This isn't a list of all the possible itemized deductions, but here it goes. First, we have medical expenses. Actually, having enough in medical expenses to be able to take an itemized deduction is difficult because medical expenses have to exceed 7.5% of adjusted gross income. For example, if your adjusted gross income is $30,000, you can only deduct your total medical expenses that exceed $2,250. So you can see that it might be difficult to get to the point of being able to deduct your medical expenses. Still, here are some examples of some medical expenses that you can deduct. Chiropractor, doctor, including psychologists and psychiatrists, dentist, glasses and contact lenses, lab fees, long-term care expenses, medical supplies, and prescriptions. Next, we have state and local income taxes, real and personal property taxes, and sales taxes. You can take a total combined deduction of up to $10,000 for all of these taxes. If you're married filing separately, you can take up to $5,000. Real and personal property taxes that fall into this category are property taxes on your home and taxes and registration fees that are based on the value of your vehicles. By the way, you can take a deduction for state and local taxes or take a deduction for general sales taxes, but you can't take both. By allowing taxpayers to take a deduction for general sales taxes, taxpayers in states without an income tax can benefit from a deduction too. The third type of expense that you can take as an itemized deduction is interest. You can take investment interest and home mortgage interest in points. So this means that you can take the interest paid on money that you borrowed to use for investments. For instance, you can deduct the interest from buying stocks on margin. You can't deduct interest that was for a tax-exempt investment or if it's loan interest for passive investments. You can take the interest on a home mortgage if it's for your main home or even for a second home. It doesn't matter if your home is a mobile home, boat, house, condo, or a co-op. As long as your home has the basics, such as a space for sleeping and a place for cooking, you can usually deduct the mortgage interest. It can be a first or a second mortgage. The mortgage can be refinanced or it can be a home equity loan. If it's reported to the IRS by the seller, you can even take a mortgage interest deduction on a seller finance loan. If you took out a mortgage loan after October 13, 1987, but before December 15, 2017, you can deduct home mortgage interest up to $1 million. If you took out a mortgage loan after December 15, 2017, you can deduct up to $750,000, but if you're married filing separately, it's $375,000. Now, if you owe more on your home than what it's worth, your deduction will be limited and you will have to make a special calculation to determine your deduction. Lastly, we have gifts to charity. Please keep in mind that in some situations, your charitable deduction might be limited. Also, for you to get a deduction, a charity does have to be registered with the IRS. I will include a link to the IRS website where you can check to see if an organization is qualified to receive tax-deductible donations. You can take a deduction when you donate money or items, including clothes, furniture, vehicles, real estate, and investments, just to name a few. You can deduct the market value of any items that you donate. You should always keep details on what you donated, how much you paid for the items, and how you valued your items. You should also get a written statement from the organization that received your donation. If you donated a non-cash item that is worth more than $500, you will have to fill out Form 8283 and attach it to your 1040 tax return. The form requires you to fill out detailed information about your donations, and you will also have to attach an appraisal signed by a qualified appraiser. So it does take more time to keep track of itemized deductions versus the standard deduction, but it can save you more money on your federal taxes. Unless it is absolutely clear that your itemized deductions would never exceed the standard deduction, you should always take the time to compare your itemized deductions to the standard deduction. Then, each year, you can just go with whichever gets you the bigger deduction. You can even file your federal taxes yourself and compare the numbers before you file your tax return. Nowadays, you can file your federal taxes for free through one of the many tax software services, so you don't have to get a preparer to compare the numbers for you. Please watch the video in the upper left of your screen if you want to check out some free tax filing options. Taxpayers in some states are allowed to file their federal taxes for free, directly with the IRS. It's a new program that will eventually be available to all taxpayers. If you want to find out more about it, please watch the video in the lower left of your screen. All the best to you.